Hello, I'm Nathan Kubik, and thank you for joining us for the third quarter of 2019 Carnick and Kubik Capital Markets Outlook. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. This past quarter, the U.S. economy has continued to improve. Domestically, we have maintained levels of slow and steady economic growth and are maintaining course within the current Goldilocks economy. The U.S. equity markets fell a bit in August, but rallied back through the end of the quarter to end slightly higher. The primary driving forces in the financial markets today continue to be the trade war, the interest rate environment, and poor international economic data. As you can see, the forces driving the markets have not deviated much over the past year, and we remain focused on potential outcomes, the corresponding impacts, and how to position appropriately for those possibilities. Domestically, we are continuing to see corporate earnings grow. The consensus of analysts' expectations correctly anticipated earnings growth levels this past quarter. In fact, many U.S. companies were able to largely exceed expectations. The widely anticipated reduction in the Fed funds rate did indeed occur, with 2 rate cuts this past quarter by 25 basis points each time. Many analysts believe that 2 more rate cuts are coming this year, but the Federal Reserve Chair Jerome Powell has indicated that whether or not that does occur will be data dependent. We continue to believe that the U.S. economy is strong enough to maintain current rate levels, but given the rest of the world's interest rate levels, other than adding an arrow to the Fed's quiver, there really isn't a good reason to hold rates higher than the market demands. The rest of the world continues to place a drag on the U.S. economy, and the trade war is likely the most influencing factor out there right now. There are reasons to be hopeful that an agreement might be reached, and we hope to see some clarity during the discussions this month. The future of the trade war remains an unknown, but for now, the domestic economy expansion is indeed continuing. Last quarter, we addressed the question of how long can this economic expansion continue. Here, we wanted to once again address the common but flawed belief that because this is the longest recovery in history, that it must be nearing the end. Looking at the chart on the left, we realize that while it may be the longest recovery from a GDP growth perspective, it's actually been the slowest. In fact, in the past, we've seen total GDP growth expansions more than twice as large as the current expansion. Now, we're certainly not saying that there aren't risks to the expansion ending, but rather that the economic expansion of today is significantly different than those in the past, and that at least for now, this domestic Goldilocks economy that we've been experiencing appears to be continuing. And the companies of the S&P 500 appear to believe just that, which is seen through the many announcements of share buybacks. The chart on the left shows the value of buybacks by calendar year. Companies typically announce buybacks when they believe their stock price is undervalued and when their balance sheet can justify the action. With lower levels of interest rates, companies are able to lock in cheap debt and strengthen their balance sheet, as well as justify these buybacks with a lower weighted cost of capital. The company's higher levels of earnings also results in a higher levels of cash and earnings power, which can also justify the reinvestment in their capital. And finally, their belief that their stock price is undervalued justifies many companies' actions of reducing the number of shares outstanding in the markets. In the chart on the top right, we can see that financials and technology companies are creating the most relative impact from these buybacks. The chart on the left here shows that corporations are indeed increasing their debt as a percentage of GDP, which coincides with the buybacks and mergers and acquisitions seen on the previous page. Further, the chart on the bottom right shows that companies are taking advantage of these lower interest rates to lock in longer bonds. This action is similar to you or I refinancing into a longer-term mortgage. Federal debt, on the other hand, appears to have remained relatively flat as a percentage of GDP. In other words, the federal debt is increasing in proportion with GDP. This is okay, so long as GDP continues to grow. The concern we should have is what happens with this increasing debt and increasing future liabilities when GDP growth slows or stalls. Looking at the chart on the left, we see that 68% of GDP is made up of consumption. The consumption bucket is made up of both discretionary and non-discretionary spending and will be a major contributing factor towards the slowing of GDP. Fortunately, consumer confidence remains high, which bodes well for continued consumption levels. Additionally, debt payments as a percentage of personal disposable income remains at low levels. This also supports the ability for continued consumption levels. Additionally, wage growth has begun to ramp up a bit and is nearing historical averages. Unemployment has just hit a 50-year record low at 3.5%. So long as inflation remains in check as expected, these are both solidly positive economic factors. Given these thoughts on the state of the economy, let's turn our attention towards the financial markets. The last couple years have been somewhat volatile. 2017 was a great year for the equity markets, and 2018 was off to a solid start before the trade war, where it fell dramatically in the fourth quarter. That fourth quarter of 2018 is still with us in our trailing 12-month or 1-year performance number. However, the last days of 2018 and into 2019, the market rallied back to record highs. Interestingly, if you look at the previous market peak, which was near this same time last year, you will see an increase for the past 12 months that is not all that impressive. Another way to look at this is that stocks got cheap during that window and have moved back to normal valuations, which is what can be seen in this forward price to earnings chart. Remember that the trade war did have an impact on earnings levels, but companies appear to have been able to overcome that impact, and earnings have resumed the upward trend that we've seen throughout this recovery. Forward PE valuation multiples for the US stocks are right around the 25-year historical average. This is not to say that we are overly bullish, but we continue to be cautiously optimistic, and we do find valuations as a whole to be in line with expectations. Having just discussed some US economic data, let's look at how the rest of the world is performing relative to the US. As you can see here, the rest of the world, as depicted in purple, has not been able to keep up anywhere near the pace of the US when it comes to stock performance. It is important to remember that the S&P 500 makes up a bit over 40% of the world's market cap. US small and mid-cap companies make up a bit over 10%, and the rest of the world is just shy of 50% of the world's market cap. We have had minimal exposure internationally for quite a while now, and continue to look for reasons that other countries have been able to turn the corner from an economic expansion perspective. But to date, we are yet to see any reason to add any exposure here. Looking at that same data over different time periods, we can see that the US has certainly been the place to be. To really drive that point home, look at the 5-year data on the right. The US has averaged an annual rate of return of 10.91%, while the rest of the world has been relatively flat. Remember that the S&P 500 is primarily large cap US stocks, but there is also small and mid cap stocks. Additionally, there are value and growth oriented stocks. So let's take a look at the different domestic styles performances. As you can see, large cap stocks have continued their leadership trend over that of small caps. Interestingly, value stocks have made up a meaningful amount of ground, gaining about 3.3% this past quarter, where growth stocks only grew about 1%. The question is whether or not this is a shift in style leadership or just a blip along the way. We would argue that it's somewhere in between, and that we're in a period of limited leadership from a style perspective. The reason for this neutrality is threefold. First, value stocks have a higher dividend rate than that of growth stocks. With interest rates being so low, income has become more appealing. On the other hand, it also gives growth companies access to capital at cheaper levels and the opportunity to invest in growth initiatives. So let's call that a neutral factor. The second item to consider is that of valuations. As you can see in the chart on the bottom left, value stocks look a bit more attractive from a straight valuation perspective when compared with their respective historical multiples. That said, growth stocks being able to invest in greater growth and take advantage of those consumption levels we were discussing also can justify a slightly higher multiple. So let's call this relatively neutral as well. Remember from last quarter's discussions that the weights for each style exposure utilize the Morningstar style box assignments, and that we would argue that our holdings are actually a bit more neutral than depicted here. So what's the third reason for our neutrality from a style perspective? The answer is sector exposure. We believe some sectors to be attractive on both the value and the growth sides, while others remain less attractive. To that end, we are more focused on underlying company fundamentals right now, adhering to targeted sector exposures and remaining a bit more neutral on the style side of things. We still like technology the best, with it being our largest overweight. Further, we find sectors like real estate and utilities to be oversold and overvalued right now. And while they've had a great year to date with investors chasing their dividend yields, we do not believe that these valuations are warranted. In truth, looking at this chart, I'm having a bit of a deja vu moment from 2014. Back then, rates were at similar levels and we saw similar chasing of dividends, and look what happened in the subsequent years. In our core equity model, we have maintained our overweight to technology and remained relatively consistent with our underweights of that of last quarter. With interest rates as low as they are, many consumer staples, utilities, and real estate companies have become quite overvalued based on historical valuation metrics. The overvaluation for utilities, based on forward price to earnings, is now more than 40% of its historical average. So we continue to focus on stronger fundamentals, and one key area of focus is that of valuations. In our dividend model, our sector weights remain similar to that of the previous quarter. As we've been discussing, dividend stocks were generally rewarded as the interest rates fell. Due to this model's focus on increased stability and an inherent tilt towards value, there was not a need for any meaningful tactical shifts. Sector and style overlays remain strategic, and we will continue our focus on strong fundamentals and dividend growth. For all of our equity models, should we see problems related to geopolitical events, negative economic data shifts, or earnings growth begin to slow, we will be making a number of tactical shifts, and sector weightings will be foremost among those shifts. Moving on to bonds, over the past quarter, the Fed has reduced the Fed funds rate twice, each by 0.25%. As a result, the short end of the curve has shifted downwards, which has reduced the amount of the inversion. The general consensus is that more rates are coming, and that remains the main reason that the short end of the curve remains inverted. Jerome Powell has indicated that the Federal Reserve would do what is necessary to maintain the current expansion, but he has also stated that whether or not rates are to be cut further will be driven by future economic data. The market believes that there are two more cuts coming, and in our opinion, the inversion does not infer that the expansion is ending. Rather, the inversion infers that the Fed is still artificially holding the short end of the curve above its natural levels demanded by the markets. And the rationale behind those demand levels, just take a look at the negative yielding sovereign debt that is still out there. In countries like Germany, France, and Japan, these countries are actually getting paid by the holders of debt. Looking at the chart on the left, we look at just how much outstanding global debt there is that has a negative yield. Currently, there is more than 14 trillion outstanding with negative yields, which accounts for nearly 40% of the global government bonds outstanding. And looking at the chart on the top right, we can see that about 80% of the global government bonds outstanding have lower yields than the US 10-year bond. With such unattractive yields globally, foreign buyers have been turning to the US as an alternative. This is depicted in the bottom right chart. Remember that much of the rest of the world is struggling economically, but so far, the US has been able to overcome this weakness in the international markets. So in conclusion, given all available indicators and economic data, we continue to feel cautiously optimistic about what the remainder of 2019 looks like. We feel strongly about the companies we currently own and the way we are positioned going into the next quarter. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking with you soon.